Will Fed break hiking rate? At the recent Jackson Hole Economic Symposium, Fed Chair Jerome Powell said bringing inflation down will also bring some pain to households and businesses. But when central bank might be willing to cease hiking interest rates? Last week, the much higher than expected inflation print was released on September 13, 2022, with the CPI month-per-month was 0.1%, higher than the expectation of -0.1% and higher than the previous CPI released in July, 0%. Besides, the inflation report showed that the prices of consumer goods and services were 8.3% higher, on average, year-over-year in August. While this represents a decline from the previous reading, it nonetheless shows that at such a level, consumers' purchasing power is still eroding because wages are not keeping up with price increases. The broad U.S. stock and bond markets have recorded double-digit losses over the last 12 months, leaving investors' portfolios even further behind in real, inflation-adjusted, terms. The Fed will continue to lift its benchmark lending rate until inflation enters a sustained downward trajectory, falling below wage growth and approaching the central bank's long-term target of 2%. But falling inflation alone may not bring an end to the Fed's campaign. Firstly, before the Fed slows the pace and size of interest rate hikes, it likely will want to see 3 to 6 months of sustained deceleration in flexible prices, which apply to goods and services that can rise or fall in cost quickly. These include things like food, energy, and cars and trucks. Secondly, the Fed will want to make sure that sticky prices, which exclude food and energy prices, are also heading back toward their target. Sticky prices apply largely to services like rents and medical care. They don't tend to change as much or as quickly as flexible prices. Last but not least, the Fed would like to see inflation expectations drop closer to 2%.